Hello and welcome. This is Magicbricks Now. You're watching Property Hotline. I'm Kavita Krishnan. We are answering all those queries that tax you when you're buying, selling, or investing in property. So if you have a tax-related question today, feel free to contact us. Our expert for the day is Suresh Surana. Suresh is the founder of RSM Astute Consulting. He joins me in the Mumbai studio. Suresh, welcome to the show. Let's get started with an email query first. SS Verma has written in and he says that he owns a property that he bought on a home loan and then leased out. Now he says that he believes he can claim deduction on the principal and the interest payment on the loan, and his employer agrees with this. However, his CA says that the maximum deduction on interest paid as per section 24B cannot be more than 2 lakhs. He wants to know what is the specific provision under which the actual loss or profit on leased property bought under housing loan is chargeable against one's income.
So, Mr. Verma, there is a very popular misconception. There is an upper limit on the deduction of interest up to rupees 2 lakhs, which is applicable in case of self-occupied properties. This is not applicable when you lease out a property. Once you lease out the property and you get a rental income, there is no cap on the interest amount which you can claim it as a deduction. The second thing is that after 1st June 2016, you need to submit the details in Form 12BB, which will contain the name of the lender, address of the lender and his permanent account number, so that the interest amount can be verified. Also, it can be cross-checked. But there is no upper limit on the deduction. So under section 22, first of all, since you asked for specific provisions, the income from house property is taxed under section 22 and the deduction of interest is allowed under section 24 subsection B. The proviso which restricts the deduction to rupees 2 lakhs in case of self-occupied property is not applicable in case of leased out properties.
So when you say, Suresh, that on property that you lease out, there really is no limit on the exemption that you can claim against the interest. What do you exactly mean? Say if I'm paying 4 lakh rupees as interest in a year, can I claim the entire 4 lakh rupees as deduction irrespective of what rent am I getting, or is it dependent on the rent?
No, it is not dependent on the rent what you get. You can claim entire 4 lakhs. Of course, under the Income Tax Act, there is a provision that what is taxed is what rent you actually receive or the fair rental value, whichever is higher. So, in case the rent is really low as compared to the prevailing fair rental value, the tax authorities can substitute the fair rental value for that.
Okay. So, it's up to the tax authorities. Say, what if it is higher?
Yeah, so interest can be higher. There can be situation because, like for example, typically if you have borrowed 75 to 80% of the property value and you are paying interest at the rate of say 10%, and the rentals which you get these days is sometime in the range of 6 to 8%. So it is quite possible that your interest payout is more than the rental income, and which is fine. So whatever loss you make on the income from house property, you can set off against your other income.
Okay.
Yeah.
So technically what Suresh is trying to tell you here is that it is very prudent, in fact, from a tax point of view, if you have a second property which you have leased out, if you bought this on a home loan, because there is really no limit on how much deduction you can claim against the interest that you're paying on the home loan. So theoretically, if you are paying 4 or 5 lakh rupees per annum as interest on that home loan, you can claim the entire thing as tax deduction. Moving on, we have Ramesh, who's dialed in from Mumbai. How can we help you, Ramesh? Ramesh, can you hear us?
Hello.
Yes, Ramesh. Tell us, how can we help you?
Yeah, my query is that me and my wife, we jointly own a property which has been rented out.
Okay.
And we are both senior citizens and we are relying on this income for running the place. Now, the thing is that to avoid all the complications of making a will and transferring the property later on to our child, we would like to gift the thing to my son and avoid the thing that he has to undergo later on. Now, my question is that the income that we are earning from this property, will it continue to be our income for tax purposes, or it will go to my son after the property is gifted?
So once he gifts the property to his son, who would the income technically go to? Who has to pay tax?
The thing is, in Maharashtra, this is the new system which has come out that in 200 or 500 rupees stamp paper and paying registration charges,
Right.
you can very conveniently transfer the property as a gift to your next
Right. In fact, Ramesh, we were just discussing that yesterday on Property Hotline, and it is a very, very smart way to actually transfer property to your own children. It's easier. It's far more easier if you don't want to make a will. You just transfer it using a gift deed.
Yes, correct, yeah.
Yeah, so I mean, so here, Mr. Ramesh, just to answer your question, in case your son is a major, if he is more than 18 years of age, then the income will be taxed in the hands of your son. But if the son is minor, then in that case, there is a specific provision under section 27, which says that in case of gift to a spouse or to a minor child, other than married daughter, then the income is deemed to be arising in the hands of the person who donated or who has actually gifted the property. So if it is a minor son, then income will continue to be taxed in your hands. But if the son is major, then it will not be taxed in your hands, but it will be taxed in the hands of your son.
Okay. Could you, Suresh, just explain that bit about transferring property to the daughter, the tax treatment over there? How is it different?
No, so again here, in case the daughter is a major, which is again she is more than 18 years, then she will be paying tax on that. But even if she is a minor, but if she is married, then also it will be taxed in the, it will not be taxed in the hands of the father or the parent, but it will be taxed in her hands only. So married daughters, there is even though they are minor, there is a, sort of exclusion. Although I don't think too many girls get married.
Legally, you should not be getting married if you are a minor. Even then you will have to pay tax. So no relief from tax over there. So the answer to your question is, if you transfer the property to your son, and if your son is over 18 years of age, then yes, he has to pay the tax on it. Query coming in on our website now. Mrs. Alexander says that she sold her older house and bought another property with the gains. Now she bought the new property near her old building. So she's unhappy with this property, wishes to sell it and buy another home elsewhere Now she says that it's just been a year since she bought this second home. She wants to know if there is a 3-year lock-in period or if she can immediately buy another home. She also asks if she'll be penalized if she buys a new home before 3 years. Obviously, she wants to clarify her capital gains over here. What do you say, Suresh?
Yeah, so Mrs. Alexander, when you have sold your first house, you claim the exemption under section 54, I presume, and that is how you have bought the property. Once you have claimed exemption, you have to hold the property for 3 years. If you sell before 3 years, then the cost of acquisition of your new property will be reduced by the exemption what you claimed. And there is another disadvantage of that, because your earlier property, what you have claimed exemption, would have been held for more than 3 years. So it would have been a long-term capital gain, and the tax rate which is applicable there is 20%, which is lower than the normal rate of 30%. But the new house you are selling within 3 years, and therefore any gain on that will be taxed at the rate of 30%. So basically you have to be very careful that do you really want to sell before 3 years. I mean, one more thing, since you have bought it just 1 year back, in case you have sold your first property in the last financial year, which is 15-16, and you have not yet filed your tax return, because the return will be filed on 31st July, you may decide not to claim the exemption at all. And for the second house, you claim the exemption, whatever you want to buy now. So then that could be an interesting possibility. But if you have already claimed the deduction, then either you forfeit that exemption, or you will have to, or alternatively you will have to hold it for entire period of 3 years.
So the last bit that you said, Suresh, is a very interesting solution, in fact. But what is the duration that she's allowed? She needs to buy it within that 1 year after selling the first property.
No. Basically section 54 allows you to purchase within 2 years of the sale of the previous property, or construct within 3 years.
Right.
So those are the time limits.
2 years.
So let's say, for example, she sold the house in, for example, April 2015. So it is subject to tax in the financial year 15-16, for which the return will be due on 31st July.
Right.
And if she has bought the new house within this year now, because she has just said it was bought about a year back, so then she may not claim exemption for this, and she may straight away claim for the second house now what she actually wants to buy.
Okay, so even if there is a paper trail that exists, which obviously would exist, it doesn't really matter, you're saying?
No, it doesn't matter, because you have opted not to claim for the, basically in respect of the first house now.
So, Mrs. Alexander, that is a fine, that's a wonderful solution there for you, where you can literally have the cake and the cake and the plate over here. Like Suresh just told you, what you could do if you've not already claimed exemption is hold on to that. Don't claim exemption right now. Sell this, buy the new property, and then claim exemption. But then when she claims exemption, she has to claim exemption on the first property, on the gains that she got for the first property. Yeah. Minus, basically gains will be minus whatever she's paid for the new property.
Whatever she'll be paying for the second property now. I mean, whatever after selling the interim property. So let's say initial property what she sold, then she had the in terms of capital gains. Then the first property she bought which she doesn't want to hold on, she doesn't claim exemption for that. And the second property which now she actually wants to buy, she claims exemption for that. So just in case she has not claimed exemption, because the timing is such right now that last year's returns might not have been filed as yet. So there may be a small window of opportunity there.
So you have a window of opportunity over there. It's almost like the house that you don't like will not exist in terms of capital gains tax. Right, moving on, we have an email query now. Peter Mark says that he bought a flat in 1990 for 10 lakh rupees. He gifted it to his brother in 2000 when he left for the USA. His brother gifted it back to him in 2005 when he returned from the States. Now currently he's gifting it back to his brother again since he's moving back to the States. He wants to know what the cost of the flat for indexation purpose will be. If the property was inherited, then how will indexation be done? He inherited a property from his father who inherited it from Peter's grandfather. That's a lot of gifting in this particular issue. What would you say, Suresh? I would say just go to a tax consultant and get it over with.
Yeah, so I mean, obviously there are multiple gifts.
Which is why he's come to you.
Which are going back and forth. But the point is, in the case of the gift of any property, the cost which is there to the previous owner is taken as the cost of acquisition. It is not taken as nil. It is taken as whatever was the cost of acquisition to the previous owner. And if the previous owner himself received it as a gift, then you go to the further previous owner. So eventually you will go to the first person who acquired in the whole chain. That is the grandfather. So that is a separate question. I presume that is an inheritance question, whereas the gifting apparently was done in 2000 first time by him to his brother, and then brother gifted back, and then he has gifted back, and now it is coming back. So I presume there are 3 or 4 gifts. The point is, whoever acquired in the first place, whatever is the cost of acquisition for him will be taken as the cost, and whatever is the period of holding. So right from the year 2000, for example, you will get the indexation for the period of 16 years, and so entire period of holding will be considered. So it simply goes back to the cost which was paid by the original acquirer and the period for which it has been held during this entire period.
Right. So essentially, in Peter's terms, it would be 1990, he says. He bought the flat. So that would be the year from which he has to calculate indexation. But here, I think, Suresh, there is the tax laws changed, right? So when does he actually have to calculate indexation from now? Because it's a 1990
yeah, so 1990 still, unless the property was acquired prior to 1981,
1980, right.
So I think, you already have a second question that in the case of the father and grandfather. So apparently the property which is inherited from father and father in turn inherited from grandfather. Again, there is a similar provision there that even in case of inheritance, you go back to the original cost of the person who bought. So in this case, grandfather, whatever cost he bought, and in case he bought the property prior to 1st April 1981, which might be the case, given the sort of long sort of history, then you take the market value as on 1st April 1981 as the cost, and then you apply the indexation, till the year of sale. So that is how basically it will be calculated. So entire period of holding by the father and grandfather will be considered. The cost will be considered whatever cost was paid by grandfather, or as on 1st April 1981 in case the date was earlier than that. And you will get the full benefit of indexation.
Right. So Peter, that's your answer. 10 lakh rupees in the case of the property that you bought, and 1990 would be the date that you need to consider for indexation. In the case of the property that you inherited from your grandfather, the year in which your grandfather bought that property, or 1981, which is when the laws actually changed, that will be taken as the indexation. And if he had bought it before 1981, then you have to take the market value of the property in 1981. Right. Moving on, we have Wasim, who's dialed in from Mumbai. Wasim, what's your question?
Good evening, madam. This is Kazi Wasim from Mumbai. First of all, thanks a lot for taking my question. The context is like this. There is a woman who has some ancestral property which a builder is ready to purchase.
Okay.
Now the question is like this. Should she distribute it to her children and they would in turn sell it to the builder? Number one. And number two is that, or she should directly sell the property to the builder and distribute the cash to her children. So please suggest to me any other option if to make the transaction tax efficient in the hands of women and her children both.
What would be the most prudent way to?
Yeah, so I think, Mr. Kaji, it's a fairly good question. So in the first case, let's say in case your mother decides to sell the property, first, and then she gives the, in terms of sale proceeds, she will be paying tax in terms of capital gains or whatever it is in respect of the property. And assuming that it is held for more than 3 years, it will be long-term capital asset. She will be paying tax at the rate of 20%. She will be getting the benefit of indexation. And then she can gift. On the gift, there is no tax because it is between the relatives who are specified under Section 56. So neither for her nor for the, in the case of children. But in case she gifts the property first to the children, and then the children are selling it in turn, they will also get the benefit of indexation and as a long-term capital gain. Because again, as we discussed in the earlier question also, that in the case of gift, the cost to the previous owner is taken as the cost, and also the period of holding, which is including the previous owner, is also taken. So even the children will continue to get the benefit of the long-term capital gains and thereby the lower rate of tax as well as the indexation. But more than that, they will have two additional benefits, which can be very interesting. The first one is that in case the children want to reinvest the sale proceeds, in case under Section 54, they want to buy a residential property, then they can claim exemption if they do not own more than one house. So apart from one house, if they buy the second house, that is okay. But if they own 2 houses, then they cannot claim exemption under Section 54F. The other thing is they can also get the benefit of the income tax slab. So each of the children can have the benefit of the slab as well as ATC deduction. So there can be some interesting tax efficiency which can be possible if it is gifted first to the children, and then they can claim exemption under 54F as well as the slab rates and ATC deduction.
So what you're essentially saying is that with the same property, if the property is gifted first to the children, then each child can claim tax exemptions separately, which means you can maximize tax benefits on a single property if this lady in question chooses to gift the property to her children and then her children go on to sell that property. Is there any time period for which they need to hold on to the property before they sell it? Any such
No,
cap?
absolutely none, because as we discussed earlier also, that in case of a gift, the cost as well as the period of holding of the previous owner is considered. So therefore, it will be a long-term capital gain, and whatever is the cost in case of mother, same cost will be taken here also.
Right. Website query coming in. Rajesh Patel says that he bought an under construction property in Surat. Now he wants to know if he should pay service tax to the government since the Delhi High Court has passed a judgment on it recently. Suresh, it's very interesting how quickly news of this judgment has really spread amongst people who are looking to buy a home. I mean, obviously, with the way home prices are going, everybody wants to save on it. But where do you stand on this? Should you or should you not pay service tax?
Yeah. So I think, first of all, thanks to media that the news spread so fast. So everyone really knows about his rights and obligations. Basically, as you are aware, there has been a recent judgment in case of Honorable Delhi High Court, in case of Suresh Kumar Bansal, where the High Court has held that service tax cannot be charged even for a property under construction since the property value includes the value of land, and which is there is no machinery mechanism how to compute the value of land in the overall construction value. Now, while this judgment was given prior to 1st July 2012, as you probably know, the service tax has been completely revamped from 1st July 2012, and now we have moved from the positive list to negative list. So, except for a small negative list, everything else is coming under service tax. So, again, the applicability of the judgment has to be seen in that context. The other point is that I think most of the builders continue to charge service tax, and one of the issue is that there might be appeal to Supreme Court on this matter. Also, as I said, that after 1st July 2012, whether the same position holds good or not. So those questions are there. And also the rate of interest, if the service tax get delayed more than 12 months, is very, very steep. It's almost 30%, which is, I think, not many laws have that kind of interest rates. So people are also worried that if the dispute goes on for a few years, you might have a very substantial interest liability coming up. So I think most of the cases people are paying under protest. Maybe they can either get an undertaking from the developer that in case of refund, it will be paid back to them. And we hope that government comes out with some clarification on this, because so many people are getting impacted. Also, there is an interesting aspect to it actually, which I would like to share, that in case of the land and in case of the buildings also, there is a stamp duty which is being paid. And the whole hypothesis was that since there is a stamp duty being paid on land and building, these things should not be subject to service tax and VAT. But what has happened over a period of time, while we continue to pay the stamp duty, we are also paying now service tax and also VAT. So I think somewhere Delhi High Court does recognize that I think there is a levy of tax which is going what was not originally intended to be goods or services, but which is a part of an immovable property.
Right. So essentially what the Delhi High Court is telling is that the tax department has got its entire math wrong. They should be charging only for the services rendered, but here you're being charged even for the land. However, the jury is still out on that, and there isn't really too much clarity coming in either from the government or from the courts. We do hear that, and most experts tell us that this will probably go into appeal to the High Court again, to the Supreme Court again, which means that there is still some more uncertainty over there. Having said that, like Suresh said, and the ideal thing to do would be to pay that service tax and pay it under protest. Now, Suresh, before we move on to the next question, very quickly, what do you mean when you say pay it under protest? You also mentioned that ask the developer, get an undertaking from the developer that he'll refund it to you. Now, what if the developer refuses to give you any such undertaking? Then what do you do?
I mean, that's a matter of, I think, tussle between but I think even the developer would be actually much better positioned, because he's paying he's already paying the service tax. Rather than, even the developer might have the same concern that if he doesn't collect the service tax today, and let's say 2 years down the line, the service tax authorities demand service tax from him, and he has already handed over the possession, it might be very difficult for him to recover service tax at that stage.
Right.
So I think obviously one of the two parties has to, sort of take a position. And maybe the other party has to be respectful to that, in case the purpose for which the tax was collected is no longer required to be paid, then it must be refunded back.
Right. So Rajesh, clearly you're a consumer, you're a home buyer who's very aware of his rights, which is why you know about this judgment. What we suggest is take it one step further, go to the developer, have a conversation with him, point out that this is the kind of judgment that's come in, and I would like to pay the service tax but under protest, and see what he says. Chances are that he's willing to go ahead with you, and in that case you can actually get an undertaking from the developer, pay that service tax, thereby safeguarding yourself from actually having to pay 30% penalty when you're found wanting for paying that service tax. Email query coming in next. Hiteshi Dadia asks that if she sells a commercial property, can she save on tax by investing in residential or agricultural property? How else can she save on taxes? Clearly, she's asking about capital gains again. Suresh, can you reinvest in agricultural property as well?
No. So first of all, if you sell commercial property and if you purchase a residential property, you can definitely claim exemption under section 54F, which is specifically designed for that purpose. The condition is that you should not own more than one house. apart from the commercial property which you are selling. So if you have one house and if you sell a commercial property and you buy a new house, till that time it is possible for you to claim the exemption. Exemption is not available for investing in agricultural land unless you are purchasing a land for constructing house thereon. In which case within 3 years if you construct it is okay. But pure agricultural land with no real residential house will not be eligible for exemption.
Right. So no exemption there on pure agricultural land. Only if you construct a house on it within 3 years, can you show that you actually reinvested your capital gains over there. Ideal thing to do is buy residential property. That's all the time that we have on today's episode of Property Hotline. Suresh Surana, thank you very much for coming in. And if you have any questions related to real estate, it could be buying, selling, investing in property. It could be legal issues, tax issues like the questions we answered today, or home finance. Get in touch with us. We'll get the country's top experts to answer each and every one of them. You can see IDs flashing on the screens. You can also personally tweet to me. I'd love to hear from you. Thank you very much.
Thank you.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/Magicbricks Now. And don't forget to click the like button. You can also follow us on Twitter at Magicbricks Now. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/Magicbricks Now.